Okay, good afternoon, everyone, and welcome back to our options education webinar series. It was quite the event this weekend in Montreal. I'm glad to have met many of you, and I hope to see many of you in September in Toronto at the next Options Education Day. But today, getting back to our regular scheduled education, today we're going to be talking about risk and money management of trading. Now, this is arguably, in my opinion, one of the most important skill sets that any trader needs to learn. And it doesn't necessarily apply to just options trading. It doesn't matter whether you're just trading stocks, options, futures, FX, any market. Managing money in your account is a skill set that is absolutely critical to the success of trading. So today what we want to do is we want to try to get ahead of the curve before market downturns can potentially hurt and blow up your accounts. We want to talk a little bit about what are the ways to go about surviving any type of market downturns. And the good thing about what we're going to go over here today is that it's not difficult from the math perspective. It requires some very simple calculations to learn what we're teaching you here today. And I'm going to talk about two different concepts that will hopefully drive everything that we're going to go over here today. Learning the difference between a linear versus an exponential function. Many of you, I know that I've spoken to you this weekend and over the years, many of you come from engineering backgrounds that trade options, so a lot of this stuff should be fairly straightforward and easy to understand. But effectively, the goal here today is to show you the different ways to look at your portfolio risk and understanding how to manage that risk so that you never blow up your accounts, because anyone who's ever traded before may have probably found themselves in a position where they may have risked too much or risked too much of their account, and we really want to try to prevent that. During the late December of last year, things got a little ugly and corrections that we saw in the market were quite violent. We want to make sure that if such an event were to happen again, how do you position yourself so that you don't find yourself in a position where you are risking a very large percentage of your account? So today I'm going to go over some simple maths and hopefully illustrate to you guys how to actually go about positioning yourself correctly for the trades that you'll be doing. So before I get started, just a quick disclaimer, what we're going to talk about here today is only for educational purposes. It is not a solicitation or recommendation to trade any specific securities. And just for those of you that are brand new to OptionsPlay, welcome. I hope that this webinar is useful in helping you better understand the resources that we offer to all of you as traders. And one of the great things in Canada is that you guys get access to OptionsPlay Canada free of charge, courtesy of the Montreal Exchange. This includes full access to the trading platform, bi-weekly options educational webinars just like the one that you're on here today, free on-demand options video library for a wealth of recordings for those of you that want to follow along with some of our previously recorded webinars, which I highly recommend if you're learning about options trading. And lastly, weekly cover call and short put reports. And you can register for all of that using this link down here, which I will put into the chat window for those of you that do not have access to an OptionsPlay account yet. So please sign up if you don't to get access to all of these things. Now, before I get started, I just want to do a quick poll here for everyone that's in this particular webinar real quick. I just want to get a sense for how many of you ever had a single losing trade, a single trade where you ended up risking a large percentage of your account. And when I say large account, meaning at least 10% of your account, how many of you have risked that much on a single trade before or found yourself where you were losing more than 10% of your account per trade? So it looks like half the votes are in right now. Looks like no is outpacing yes about 2-to-1 right now, which is good. Certainly, I'd like to hear that more people have not found themselves in this situation than have. However, I think that the fact that, here about 2/3 of you have voted already, so let's go ahead and share these results. The fact that 1/3 of you have found yourself in that position is certainly one of the reasons why we want to address this, because it doesn't take many of those scenarios before you can find yourself in a lot of trouble on a specific trade. So before I go on to starting my actual presentation, I just want to get a quick sense for the users in the room here. So how much of your account do you risk per trade is the question that I want to pose to the group here. Okay, so with about half of you voted, the distribution is actually somewhat stable and kind of what we're expecting here. So with about 2/3 of you that have voted now, let's get a sense for where we are. Okay, so let's see. 37% of you say you risk 1 to 2% of your account, 31% say 2 to 5%, 22% say 5 to 10%, and 10% of you say 10 to 20%. So this is really going to frame a lot of the work that we're going to walk you through today, and we want to show you why. Even though the largest percentage of you have answered 1 to 2%, there are still almost 60% of you that have answered greater than 1 to 2%. And we want to show you why you generally want to lean more towards the shorter end of the spectrum or the smaller end of the spectrum. So that's what I'm going to share with you guys here today, but that was a great understanding as to the audience here and what you guys currently utilize in terms of helping you manage risk, because this is really how we want to think about our portfolios, is how much of our portfolios are we risking per trade. So the first thing we're going to go over is the golden rule of risk management. What that golden rule is, I'm going to just lay it out from the very beginning. Not going to expose that at the end. And then what we're going to do is we're going to work backwards to really understand why the golden rule of risk management applies. And to do so, we're going to first have to explore the difference between a linear versus exponential function, why that's so important in understanding the golden rule of risk management. And we're going to apply to a few different things. We're going to look at your high water mark, why it's difficult to get back to a high water mark once you've incurred some losses, and that really helps illustrate why the golden rule is so applicable. We're going to talk about blowing up your accounts. You know what it takes to blow up your account to hopefully work backwards to prevent you from blowing up your account, and then thinking a little bit about how many consecutive losses do you need to plan for realistically for a trading strategy. So we're going to go over different trading strategies and what type of consecutive losses you need to plan for, what are the different things you should be thinking about when you think about consecutive losses, and then lastly, I want to show you a risk and money calculator that will allow you to effectively calculate all the things that we're going to show you here today so that you can apply the golden rule of risk management to your trading account as easily as possible. So first of all, I'll start off by the golden rule of risk management, and it's pretty simple. It's simply risking no more than 1 to 2% of your portfolio per trade. What that means is that you can take a look at this chart here that I have here, and what I have is different account values. So this is your trading account size, if you will, and the dollar amount that you can risk per trade based on different percentages of your account that you'll risk per trade. So if let's say you have a $25,000 portfolio, to risk anywhere from 1 to 2% is risking anywhere from $250 to $500. And the sweet spot is usually somewhere around this 2% mark. So you can utilize this account value table to get a sense for roughly how much you want to risk per trade. And like I said, we'll have a calculator for you at the end so that you can plug in your account value and see what that 2% number is. But that's the golden rule of risk management, is that if you only risk no more than 1 to 2% of your portfolio per trade, you'll experience much better performance in your portfolios in the long run than if you were to risk more. And we want to show you why. So what you want to do is you want to gain control of your portfolio by simply focusing on controlling your losses, as opposed to thinking about, because usually when we trade, we think about what are our potential rewards, what are our potential gains. But to really grow your portfolio in the long run, what you really should be focused on is controlling your losses, and we're going to show you why. And the goal of providing good risk management is simply to make sure that you have enough dry powder in your account to live another day. Because if you blow up your account, then you no longer have any more capital to continue trading, and that's what we want to avoid for everyone. So everything we're going to do today is going to work backwards to show you why. So in order to really understand why we apply this golden rule of risk management, we have to first understand a little bit about the difference between a linear versus exponential function. So when we talk about returns, it's really a compounding function, which is an exponential function, as you can see as time goes on. An exponential function certainly grows very, very slowly at first, but actually accelerates as you go further and further out in time. And that's the function that our accounts grow and lose at. And that's one of the things that's so important to understand the difference between a linear function and an exponential function. So returns are compounding. That's a very powerful tool which can work in your favor or against you, because both gains and losses will result in exponential gains, and losses will result in exponential losses. So minimizing risk is critical to preventing your total portfolio loss, because it doesn't take many losses before you are where it becomes almost impossible to come back from. And this is really what we're hoping to illustrate to you. So the first one we're going to talk about is the amount of gains that's required just to break even. And the losses that you have are certainly linear, but the gains that you need to get back to break even are exponential. So this is really why it's so important to make sure that you minimize the drawdown in your portfolio. And one of the best ways to do that is to trade small size, because the gains required to break even grows as an exponential pace, even though the losses are growing at a linear pace. So the goal here again is to minimize your portfolio drawdown. And as you can see, when I lose 10% of my portfolio, it requires an 11% gain to get back to break even. A 20% loss requires a 25% gain. And as you can see, for every 10% I lose in my portfolio, so imagine if you risk 10% of your account per trade. Then if I have 5 losing trades in a row, by the time I have 5 losing trades in a row, I now need to make 100% return just to get back to break even. So at some point you see that, the further down I go in terms of losses, the more unrealistic I can even expect to get back to break even, which makes it almost impossible for me to continue trading to a point where I can get back to break even. And keep in mind, the more you lose, the less capital you even have to try to get back to break even. So that's why you have to ask yourself, have you ever risked 5 or 10% or more of your account in a single trade? Because if the answer is yes, you will easily find yourself down 30, 40, 50% after just a few losing trades, and at a point where you no longer even have the ability to come back, because the gains that are required just to break even are effectively astronomical and almost impossible to get back to break even. So this is the first reason why we want to make sure that you want to keep to the lower end of the spectrum, so that you have a fair chance of getting back to break even after a few losses. And the really rule of thumb here is that if you've lost anything more than 25% of your portfolio, it becomes very difficult to actually recover from that. So the goal here is to really try to prevent your portfolio from ever losing more than 25% of its total account value in any major drawdown of your account. So let's go ahead and try to think a little bit about the number of trades it actually takes to get to that point, right? So for every 1% less that you risk results in a very large growth in the number of trades that you can make before you blow up your account. So, and the goal here is to simply maximize the number of trades to blow up your account by minimizing the risk that you're risking per trade. Because if you're risking 10% of your account per trade, all it takes is 10 trades and you've blown up your entire account. Now, 10 trades might sound like a lot, but for any of you that have ever traded options, I think you'll know that 10 trades is not really that much, especially if you can have a few trades in the same expiration. You can easily find yourself where you've lost 3-4 trades in a single Friday. And this is really why we want to move ourselves towards the other end of the spectrum. As you can see, if I'm risking 5% of my account per trade, I can double the number of trades. But as I keep moving lower and lower, as you can see, at that 2% level, it requires 50 trades in order for me to blow my account. Now think about that. Think about losing 50 trades in a row and what it would take to have that happen versus having 10 losing trades in a row. 10 losing trades in a row certainly sounds unlikely, and certainly, but certainly not impossible, right? But having 50 losing trades in a row, I would think that for most people, if you were losing anywhere close to that, you would probably, number one, reevaluate your strategy. You'd probably reevaluate whether or not options trading or what you're doing is the right strategy, or maybe at that point you might want to do the exact opposite of what you've been doing. And if you're risking 1%, it would take 100 losing trades in a row. Certainly a lot more time for you to reflect on your strategy, what to do, versus 10 trades in a row. You could find yourself down half your account value very, very quickly if you're risking 10% of your trade. So that's why risking anywhere more than 5% of your account will result in 25% portfolio losses very often. And again, our goal is to minimize the ability of ever losing more than 25% of our account, which is why, again, we iterate again that we want to focus by limiting the amount that we're risking per trade in that 1 to 2% range, so that you literally have to have 50 to 100 consecutive losing trades before you're at the point where you've blown up your entire account. Those are the types of scenarios that you want to put yourself into, because that's when you realistically can say that I'm probably not going to lose 50 to 100 losing trades in a row in my trading account. So let's move on to the next one. Next, what I want to look at is the probability of having consecutive losses, right? Because we've talked about, if I risk 10% of my account, 10% of my account per trade, I can take 10 consecutive losses before I blow up my account. If I risk 2% of my account, I can risk 50 consecutive losses. But the goal here is not to just prevent blowups, but to prevent your account from losing more than 25%. So what you generally want to do when you're trading any form of options is you should try to plan for having at least 5 to 6 consecutive losses as a kind of a worst case scenario, meaning you just have a really bad month where you put on some really bad trades, where you thought the markets are going to go higher, so you loaded up on a bunch of calls, and for one, maybe something happened in the markets and they really fell and you lost out on all trades that you have. So I think it's realistic for any options trader to plan for, a rainy day of having at least 5 to 6 consecutive losses at any one point or any 1 month. So the goal here is to try to keep the losses in your portfolio to less than 25% of your portfolio. So if you're risking 2% of your account per trade, and you have 5 consecutive losses that month, that means you're risking only 10% of your entire portfolio. That's still well below the 25% of your account per trade. So what I have up here is a chart of the probability of consecutive losses based on your win rates. So the win rates many times is determined based on the type of strategy that you trade. So if you're long calls and puts, your win rate is going to be somewhere in that 30 to 40% range. You're going to have low probability of profits, but those are usually traded off with higher risk reward ratios. But as you can see, if you have a 40% win rate, to have 5 consecutive losses, you have about a 7% chance of that happening. At 9 consecutive losses, you have about a 1% chance of happening. You have less than a 1% chance of having 10 consecutive losses in a row. Conversely, for those of you that are selling options, whether you're selling covered calls, cash secured puts, or even credit spreads, you're going to find your win rates on the higher end of the spectrum, whereas you can see the chances of you losing 6 consecutive losses in a row with a 60% win rate is significantly lower at about 41.4 of 1%. So, like I said, depending on, most traders will find their win rate somewhere between 40 to 60%. As you can see, 5 to 6 to 7 is usually the spot at which things start to turn, where your risk or your chances of having that many consecutive losses is roughly close to 1%. And that's why I usually say you want to plan for at least 5 to 6 consecutive losses, because that is reality. If you trade options, there is the possibility where you could have a bad month where you lose 5 to 6 trades in a row. And you want to make sure that when that happens, you don't blow up more than 25% of your account, because again, if that happens, it becomes very difficult to come back from. But what I want to say is that sometimes can be a little misleading, because you need to concentrated positions need to be grouped together. What do I mean by that? If, let's say, you decide to buy 5 different calls that all expire on the same expiration Friday, that, generally speaking, in my opinion, doesn't count as 5 consecutive trades, because all it takes is the market to go down that 1 week, and now you've lost on all 5 calls that you've purchased. Now, that is an oversimplification of what I'm trying to say, but I think most people understand that if you concentrate all your positions into long positions in the same sector on the same expiration date, they kind of count as one single trade, even though they may be on 5 different names. From a risk management perspective, they can be grouped into a single trade. So you have to also think about, are you distributing your trades across long, short, across different expirations, across perhaps even different sectors? Because they really have to be distributed for them to be counted as separate individual trades. Many times we'll typically find is that users may have different group trades. So you might have 2 long calls that expire this month, you might have 2 short puts the next month, and you might have some other ones in a different sector. So that, instead of being counted as 6 separate trades, it really should be counted as 3 consecutive trades. And that's really where you have to start thinking about that from your portfolio risk perspective. So when we talk about risking 2% of your account per trade, and you have 2 trades per expiration cycle, and we're planning for 5 consecutive losses, that means that you're risking, instead of 10% of your portfolio, you're risking 20% of your portfolio, because let's say you have 2 trades in the same expiration. So that's really how you should think about your portfolio loss. So think about the same equation, but let's say you're risking 10% of your account, where you have 2 trades per expiration and you're planning for 5 consecutive losses. That is going to account in 100% portfolio loss. This is really why it's important to think about not just the trades not just how many individual trades you're making, but are they grouped together? Are they distributed across expirations and long, short, and sectors? Because if they're not, they need to be grouped together from a portfolio risk perspective. Because at the end of the day, we're not just concerned about the risk of a single trade, we're concerned about the risk of your entire portfolio. Because if your entire portfolio drops by more than 25%, it becomes increasingly difficult for you to get back to break even from that point. So, which is why it's so important to think about this on a portfolio level, just not just on a trade level. And lastly, the one thing that does work in your favor is stop losses can potentially reduce the amount of that you are trading, that you are risking per trade. Now, I will say that stop losses are not always guaranteed. So the market can open up well below your stop loss price, and you can get executed at a really terrible price. So stop losses are not foolproof. But if, let's say, you were to place a stop loss at 50% on all the trades, what that would effectively do is reduce your risk by half. So if, let's say, you're risking 2% of your account per trade and you have 5 consecutive losses, that will result, sorry about the typo here, but that's actually a 10% portfolio loss. But if, let's say, you do the same trade where you're risking 2% of your account per trade and you have 5 consecutive losses, but you put a 50% stop loss on your option orders, now you're only risking half as much. Instead of 10%, it would actually be 5%. Again, I apologize for the typo on this. I will actually fix that before I send out the recording with the slides. But I hope this illustrates the fact that if you do place stop losses on all your option orders, you can, again, further reduce your risk on a specific trade by putting in a stop loss. Just that, be careful, because stop losses don't always take you out exactly 50%. You could lose 60% before your stop loss is executed. So one of the things to consider on a stop loss order. But that is one of the, in my opinion, one of the better ways to continue or further manage your risk on a portfolio to try to prevent yourself from losing more than 25% of your account value per trade. So going back to our original spreadsheet, the dollar amount you want to risk per trade is simply just a function of the total account value that you have, and you want to use that dollar amount to calculate the number of contracts that you want to risk per trade. So for example, if you have a $50,000 portfolio, $50,000 portfolio states that you can risk roughly about $1,000 per trade. So if you're trading something that costs you $200 a contract, then you can risk a total of 5 contracts. So this is really how you can utilize this tool, which I will send a link to everyone as to how to access this. is the OptionsPlay Calculator that we created that allows you to put in your account value, the percentage that you want to risk per trade, and it will spit out the exact dollar amount that you can risk per trade. And then you can, when you're actually looking at an options trade, you can actually you can type in the number, the price per contract, and we'll spit out the number of contracts that you can trade. We built this in a way so that it's easy for users to understand how to take this formula that we're showing you, but be able to do all the calculations for you. And what you'll get when you use this link is the spreadsheet, which allows you to enter your your current account value. It will spit out the amount that you can risk per trade. So if you're trading something that costs you $300 a contract, it will tell you the number of contracts that you can trade. Now, we also have this built into OptionsPlay. So for those of you that are brand new to OptionsPlay, welcome. This tool is designed to make your options exploration and analysis as intuitive as possible. The platform itself is divided into 3 sections where you have trade ideas and watch lists on the left-hand side, the security analysis panel here in the middle, and lastly, trading and income here on the right-hand side. And we call these 3 panels the what, the why, and the how of options trading. And the goal here is to really make sure that you understand what symbols do you want to pay attention to, why should you pay attention to it by clicking on any symbol and instantly giving you snapshot technical analysis data to tell you the 1-month and 6-month trend, the relative strength of the stock, the earnings, dividends, and price action that's currently important corporate action dates, and then lastly help you leverage that into specific option strategies. So you can select either I'm bearish on BMO and look at 3 bearish strategies, or select on I'm bullish and select 3 bullish strategies. Now, what you can use is our platform will actually calculate for you the appropriate number of contracts if you simply plug in the amount that you're willing to risk. So what you want to do is you want to use our calculator, put in your account value. So let's say you have a $100,000 account. It will spit out that you can risk $2,000 per trade. What you want to do is you want to plug this into our risk and investment calculator. You can select I want to risk, type in the dollar amount that our calculator gives you, and now it will tell you that if you wanted to go, if you're bullish on Bank of Montreal, you can buy 195 shares, or you can buy 7 contracts of the 99 strike calls, or you can buy 8 contracts of the 99-105 call vertical. And each one of these will have roughly the risk of about $2,000. So here in 1974 versus $2,000 on the call and the call spread, exactly the dollar amount that you're willing to risk, so that you can utilize this tool to do the calculations for you. And for those of you that don't use OptionsPlay, or if you're using another platform to help you decide how to trade, you can always use this calculator to plug in the dollar amount per trade. So for example, this premium on this call option is 282, so you can plug in 282 and we'll spit out the 7 contracts. But like I said, OptionsPlay does the work for you, so it automatically calculates that you can trade 7 contracts right here on your screen. So you can utilize this tool in many ways to make sure that you are able to stick with these specific rules, because it's so important to prevent your account blowups by risking only a small dollar amount in your trade. And the best way to do so is doing it using the calculator, either on your OptionsPlay tool, or for those of you that want to download this spreadsheet, I'll put this link in the chat window that allows you to download the spreadsheet that I just showed you. Very easy to plug in your account value and then plug in the dollar amount that you want to of the option contract that you're looking at, and it will tell you the number of contracts that you can trade. And if you stick to these types of plans, you will basically be able to make sure that you never risk more than 1 to 2% of your account per trade. So just to review everything that we're talking about, the golden rule of risk management: risk no more than 1 to 2% of your account per trade. Remember that returns and losses are compounded exponentially, and it's a really powerful function that can help you grow your returns. However, if your losses start compounding, you won't have an opportunity to grow your returns. And that's why it's so important to make sure that you focus on controlling your losses more so than focusing on your upside. Because if you don't focus on your losses, there will be no more upside because you've blown up your account. So the goal here is to minimize your portfolio drawdown. You want to plan for a worst case of at least 5 to 6 consecutive losses. And that means distributing trades across expirations, sectors, and long short to really help you make sure that those 5 to 6 consecutive losses don't happen on the same week, if you will, if you have all your positions concentrated in a single expiration date or sector or long short. So those are some of the ways that you can utilize the tools that are available to you here at OptionsPlay to really make sure that you stick to these rules. And I hope that this webinar today helped illustrate why it's so important to focus on your losses as we look through some of those slides and some of those charts. So with that, I just want to thank everyone for taking the time out here this afternoon. Like I said, this was not an options-focused webinar per se, but this is, in my opinion, one of the more critical pieces to successful options trading is making sure that you manage your losses and manage your risk. So what I'll do is I'll open this up for Q&A for those of you that are brand new to OptionsPlay. If you want to sign up for this, again, please register for this using the link that I just sent to you, everyone, in the chat window. And what I'll do is I'll open this up for Q&A. If you have any questions regarding anything that I just went over here today, please type them into the chat window or the Q&A window, and I'll answer as many questions as I have time for. Matthew, thank you so much. I really appreciate it. Stephanie, thank you so much as well. Are there any questions regarding anything I went over here today? Bradley's asking a question here. When you identify risk, the amount of contracts, but how far to let price run against position? So, great question. Michael's asking that question. Great question, Michael. So one of to answer your question, the answer is it depends. It depends on the type of strategy that you're trading. If you're just long a call or a put or a vertical, so if you're buying any form of option, that rule is fairly simple. Generally speaking, a good rule of thumb is to cut your losses at 50%. So putting a stop loss at 50% is usually a good rule of thumb. If you're selling options, like if you're selling either a credit spread or iron condor or butterfly or straddle, that's where it gets a little complicated. And it depends on the type of strategy you're doing and how much income that you're receiving. So the rule of thumb here is if you're buying, setting a stop loss at 50% is a good rule of thumb, but then for each selling strategy, it really depends. If you want to learn more about that, I highly recommend you to take a look at our previously recorded webinars that will help you identify what are some of those rules for specific strategies. Bradley's asking, when purchasing a call, the risk seems easy to know. How would you define risk when selling a put? So specifically on a stock you might want to own if you get assigned. So Bradley, selling a put, from my opinion, is an easy one to figure out because when you sell a put, you're effectively saying that I want to buy the stock at a lower price. That's it. There's really no more that you need to think about in terms of defining your risk of selling a put. You need to then think about how much money am I putting up to purchase that stock. Now, if I were you, I would make sure that that stock itself is no more than, so that depends on how much money are you willing to risk on the stock. And you want to make sure that you're selling the appropriate number of put contracts to account for that. So one of the best ways to go about doing so is by utilizing our income tool, because when you sell a put, it will tell you exactly how much you're risking on that specific put. So you have to put up $9,600 to buy effectively 100 shares of BMO. Now, when you're buying stock, you generally are probably more comfortable risking a larger percentage of your account. Maybe you're willing to risk 5% of your account on a stock that you own. So you just have to make sure that $9,600 does not exceed 5% of your overall portfolio risk. So if let's say you have $1 million portfolio, then you might want to adjust this so that you have roughly 5% would be 50,000. So about 5 contracts would get you to 48,000, which is 5% of your portfolio. So that's how I would think about risk of a short put, is how much money would it actually cost you to buy those shares. Claude is saying, do you always take trades that have a delta of 75 or more? I'm not sure what you mean, because we usually don't take trades that are a delta of 75% or more. If you want to clarify as to a type of trade, maybe I can answer that question, Claude. Morel is asking, are the slides available for download? Yes, all the slides are available for download, so you'll receive an email from us afterwards with both the recording and the slides for you to download. Barry is asking, are the past replays of these series available? This is my first session. Yes, we have the whole series available. Let me just send everyone a link so that people can access it. 1 second. I will send that link in 1 second here. So for those of you that want to view all of our previously recorded webinars, I just sent the link to everyone in the chat window with the link to our YouTube channel, which has all of our previously recorded webinars. So Barry, if you want to look at those webinars, you're able to do so. Azim, very good insights, really helpful, and reinforces what some and many may already know, but this is helpful. Exactly, Azim. I think a lot of you have some degree of understanding as to the 1 to 2% rule, but hopefully what this solidifies as to why you are risking 1 to 2%, and you're not just following it because someone else told you to do so. The math behind it is pretty strong, and it's really not that difficult to understand. Once you kind of understand the difference between exponential and linear functions, it's really easy to understand why it's so important to understand or pay attention to downside and rather than upside, because if you don't pay attention to downside, there will be no upside. Matthew saying, is OptionsPlay only for Canadian markets? No, OptionsPlay is available for both US and Canadian markets. It's just that the Canadian version is free of charge to everyone, courtesy of the TMX. If you want to have access to the US version of OptionsPlay, you can just go to optionsplay.com and sign up for a free trial there. It's not free, but it is available for those of you that want to use options. So Claude is saying long calls. So long calls, we usually start with at the monies for long calls, Claude, usually not a 75 delta. 75 delta is usually a little too high for a long call, unless you're talking about a deep in the money call option where you're trying to replace the stock, but I wouldn't go 75 delta on a long call for just a short speculative trade. Would you advise using the Kelly criterion for trading sizes? I'm actually not sure what the Kelly criterion is, so if you can elaborate, I'm happy to answer that question. A teacher told me that options with delta lower than 75 were lottery. I'm guessing you meant lottery tickets. I can sort of understand why someone would say that, but I don't necessarily agree. I don't agree that you need to go that high of a delta. I think anywhere from usually 50 to 60 delta is a good starting point for most users, especially on a short-term play. Again, if you're talking about a long-term leap or you're trying to basically replicate the stock, then yes, I do agree that you want to go a lower delta. As you can see, if I go a really high delta, notice how the stock leg and this call look almost identical. That's the benefit of having a high delta call. I wouldn't say one is better than the other. It's just two completely very different strategies in my opinion. Delta equals probability of success. I also don't necessarily agree with that 100%, because when you're talking about long options, you never hold it to expiration. So yes, delta is probability of success if you hold it all the way to expiration, but we usually don't buy calls and puts with the intention of holding it to expiration. Our intention is always to exit prior to expiration, which is why probability and delta and probability of success don't really mean a lot as far as being long a call or a put. Sylvia, Silvana is asking, is there a way of knowing which is the best expiration to take? Well, that also heavily depends on what type of strategy you're trading. If you're long a call or a put, usually a good starting point for expiration dates is 2 months, a month and a half to 2 months out. If you're selling options, you want to go much shorter. About 4 to 6 weeks out is usually a good starting point. But again, it heavily depends on the type of strategy that you're trying to deploy here. And Michael's saying delta is an estimation of probability of in the money, and that's correct. It's only a probability of in the money, not a probability of success. Because delta doesn't account for the time decay of an option and from a probability perspective. So that's one of the things that it's important to understand. And someone sent me a link on the Kelly criterion. I don't have enough time, in my opinion, to read this on the fly and provide if you don't mind, I'll take a look at this. If you don't, you can send me an email at info@optionsplay.com. I'll take a look at this maybe when I have a chance and provide some thoughts. I unfortunately don't have enough time to do this live on this webinar. A delta is simply just the probability of that strike being in the money. That's it. Not touching or success. It's just probability of being in the money. That's what delta tells you. It's an approximation for the probability of being in the money. Any other questions? Sylvana is asking, how well has the OptionsPlay score worked out in the past? So OptionsPlay score is not an actual score on the trade per se. It's not telling you whether a trade is going to work out or not. The OptionsPlay score just simply tells you the risk or reward of an option. It's just telling you how cheap or expensive a call or a put is. So buying this put call option at 680 bucks is quite expensive, and that's why it's got a score of 75. And the reason that we created the OptionsPlay score is because most people will look at max reward of this call unlimited, max risk is 680, and probability of profit is 42%, and not really know whether that's good, bad, poor, risk, poor, good from a risk reward perspective, from a probability perspective. And we realized that it's hard to calculate these things, even if you knew what all of these things meant. And also, how do you compare something with unlimited reward to another strategy that has a max reward of only $350? How do I know what the risk reward of these strategies are? And that's why we created the OptionsPlay score. The OptionsPlay score isn't going to tell you whether the stock's going to go higher or lower, which is what generally affects the actual outcome of your trade, but it tells you how well balanced the risk and reward of each strategy is. So meaning if the probabilities of, it's looking at probabilities of if the stock was to move higher, if the stock was to move lower, how well balanced is the potential reward to the potential risk. That's all it's telling you. It's not telling you what the outcome of the trade is, which depends on the direction of the market. Raymond, thank you so much. I really appreciate it. Any other questions? OptionsPlay score, is it based on any time frame? It's based on the time frame of the expiration date. So it's looking at the potential moves of the stock between now and July 19th for this particular call. It's looking at an equal opportunity of the stock moving up or down, and taking a look at what are the payoffs, if you will, if the stock was to go up, if the stock was to go down, and how well balanced your potential risks are to the potential rewards. Julie's saying, can you suggest a video for reading charts on OptionsPlay? Yes, I actually can. If you give me 1 second, let me just look at the OptionsPlay YouTube channel, and I will suggest a specific video for if you want to learn more about the charts. So we have a specific one on directional strategies. So let me find that. So I'll just post a video to the chat window now. This is if you want to learn more about reading the charts on OptionsPlay, I highly recommend you to take a look at that video from our YouTube channel. Is there an option of the week thing like on OptionsPlay? No, I wouldn't say there's an option of the week thing. The point of this platform is to allow you to type in any symbol and instantly see strategies that you can utilize, either bullish or bearish, on each individual stock or ETF. Tony, how do you place stops for options? Great question. That will heavily depend on your broker. So the best thing from my suggestion to you is call up your broker, say I have an options position, I'd like to place a stop order on this. Can you walk me through how to do so? Because it really just depends on each broker as to how they go about allowing you to do that. So it's hard for me to comment. Julie, you're very welcome. Any last questions? Susan, you're very welcome. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. Today was a short and sweet webinar. However, I think it's one of the most important ones to learn for those of you that are trading options. So I really hope that you guys have found this insightful, and I hope you guys find the calculators that we've built here, either through downloading that Excel spreadsheet or just the calculators that are built directly into OptionsPlay, will help you stick to that golden rule of risk management and prevent you from blowing up your accounts. Do you have a recommendation or favorite book for option strategies? I actually do. Let me look it up real quick. It's called Understanding Options. There we go. I'll share a link with everyone in the chat window. It's a book by Michael Sincere, Understanding Options, the second edition, which was updated in 2014. I think it's one of the better beginner option books. Michael keeps things really simple. He's actually a subscriber to OptionsPlay. I've spoken to him many times. I've read his book. I've read a lot of his writings. And I just think it works pretty well with the kind of the thought process that we have here at OptionsPlay, which is to try to make options as intuitive as possible for users that are not professional options traders. And that's really what we strive for here at OptionsPlay, and I think Michael does a good job of doing that in the book. So again, thank you everyone for taking the time out here this afternoon. I will send out both the recording and the webinar in about and the slides in about half an hour. I'll change that typo that I have in the slides before I send that out. And I want to thank everyone, and I hope you guys have a great evening, and I'll see you guys on the next webinar. Have a good night.